Let's talk to Ronnie Chopra. He is the Chief Market Strategist for Knightsbridge Trading Academy with a capital A. Very good morning to you, young Ronnie. Right, 3 thought-provoking charts. The art of contrarian thinking whenever I see you. Let's kick off with the FTSE100. Obviously a dreadful week on the global markets last week, although it did outperform the US in particular, I noted. What's your field position at these levels?
I think, well, this morning we've had a pretty sharp rally in the FTSE100 after yesterday's 600-point gain in the Dow. And I think below 7,000, the FTSE is very attractive, especially from a global perspective where we have all these multinational companies that are on far lower price-earnings ratios and much more attractively priced than some of its global peers. And today we've outperformed the other European markets also because the pound has weakened. It's still an index that benefits from a weak pound.
Yep.
And this morning we're up more than 1.5% and we're back above the 7,000 level. But looking at that chart, it does look quite dreadful, doesn't it? We're at levels not seen since 2016. So we have come off considerably, and this year we're down more than 10-11% from the peak. So there's certainly value out there, but with all the geopolitical risk and the problems in the US and the Iranian, Saudi Arabian situation, we have domestic issues in the US. You know, every day there's something new about Trump, and the Facebook scenario, which has put a lot of downward pressure on the FANG stocks. The Nasdaq has weakened considerably, and that has been passed on to the likes of the FTSE100. But reiterating the fact that the FTSE100 is on a lower price-earnings ratio, if the market continues to stay like this, then there will be a lot of bids for FTSE100 companies. We've seen that in the FTSE 250.
Yep.
We haven't really seen any large ones in the UK for the FTSE100, except for GKN recently. But yes, certainly value below 7,000. There's a lot of money on the sidelines waiting to come into the market. But as they say, if the US sneezes, we catch a cold.
Absolutely. Okay, so we like the FTSE100. Let's move on to the Royal Bank of Scotland. Again, that chart doesn't look particularly good to me. Do the fundamentals tell you anything different?
I think, obviously, RBS over the last 10 years has been a complete disaster. And the last set of results did show that they made a profit.
Yep.
So they are recovering, albeit at a much lower pace than the likes of Barclays, Lloyds. And I see these as a recovery situation. And just last week, the CEO, Ross McEwen, he said that once the litigation is out of the way, because they still have to pay this huge fine, which we don't know how much yet, to the US with regards to the selling of mortgages.
Or mis-selling of mortgages.
Mis-selling, that's right. And so once that's out of the way, he said that we'll start to pay a dividend. So they haven't paid a dividend for a number of years. And once they start paying a dividend, then we'll get more investment managers buying into RBS because they need the income stocks. And apart from, you know, the extremely low price, what they're trading at the moment, around the 260 pence mark, which is 26 pence in old money because they had a 10-for-1 consolidation, that's right. And with the onset of interest rate rises in the UK, banks benefit, and we're pretty likely to have one in May. And so with the net interest margin, the difference between the borrowing and lending, this should further give a boost to the likes of RBS. So yes, they are a contrarian play. They've been
one you would have in your portfolio.
I think 2018 will be a good year for them. I think they will recover and they'll outperform the other banking stocks.
That's a punchy call. Right, let's wrap up with Tesco's PLC. Again, if putting the charting hat on, I think some people would see a double top there, which is a bearish formation on a break of the 200 pence level. What are your thoughts?
I think the recent acquisition of Booker was a good one.
Yep.
And they're going to save £200 million in cost savings with the acquisition. So the synergy benefits are obviously beneficial to the share price and their earnings enhancing. So it was a good deal there. But looking further ahead, they've said that they intend on doubling their margins by the year 2020. And with their economies of scale and their purchasing power, etc., and if they can get the margins to double where they are now, they're just going to be a cash-making machine, aren't they? And by doubling their profits, that should certainly give a boost to the share price. And these have been fairly strong, really, in the last few months. If we see from November, they've picked up from below 180. They've outperformed the FTSE 100.
Right.
Whereas the FTSE 100 is languishing near a 2-year low. Tesco's have outperformed.
Right.
But obviously, 5-6 years ago, these were trading at above 300 pence. So, you know, they've recovered recently, and I think that with the acquisition of Booker, with the cost savings, the synergies, and the likelihood of margins doubling over the next 2 to 3 years, these are an attractive play, and certainly the pick of the sector.
The pick of the sector. On that note, Ronnie, lovely to see you. Thank you very much indeed for your time.